So let's look at scenario 1. John and Mary both had several careers during their working life. Mary was a school teacher who put money into a 403(b) for several years. John worked for several professional firms and had a 401(k) at each. For a time, he was also self-employed and started a SEP IRA, self-employed pension. All of these accounts now are in 100% deferral, as Mary is only 63 and John is 65. They will not be forced by the IRS to take any distribution from any of these 4 retirement accounts until the age of 70 and a half years old. John and Mary live very comfortably on Mary's pension and John's Social Security check, and they're enjoying watching their IRAs, 403(b)s, and other pre-tax accounts grow and not needing additional income. However, in this scenario, there's a false sense of security. It's almost a tragedy, as they are not withdrawing from their IRA. Let's look at a scenario where that IRA grows until John has reached 70 and must start withdrawing money from his 3 accounts. If the account balance is currently at $600,000 and it grows at a conservative interest rate at 5%, then by the time he turns 70 and a half, those 3 accounts will total $760,000 or more. Now let's say John simply says we do not need income, so we are always going to take the minimum amount, only the amount the IRS forces us to take, the required minimum distribution, or RMD, at age 70 and a half. His RMD, which is the required minimum distribution that the IRS forces him to take, would be approximately $27,738. That amount added to the income already on his tax return, along with his Social Security income and Mary's pension income, then creates a double taxation dynamic. Why? Because Social Security is only not taxed up to a threshold. Then it becomes taxable. So in this scenario, as soon as those RMDs, the amount the IRS makes you take from your IRAs at 70, that also creates a second tax on 50% of John's Social Security check, which was previously not in the calculation for taxation. Then, when we show Mary's minimum distribution starting to be also withdrawn from the account, the problem is further escalated. John's RMDs have gotten slightly larger every year, because that is the requirement by the IRS. Mary's RMDs have just started based on the assumptions we've been looking at, which again are conservative. Mary's new required minimum distribution and John's ongoing, slightly larger required minimum distribution now looks like this on the same tax return, causing the Social Security to be taxed at 85%, which was previously only supposed to be taxed at 50%, and before the IRA's RMDs, it was being taxed at 0%. And again, John and Mary don't need this money to sustain the lifestyle in which they are accustomed. They view this money as their hard work, their emergency fund, their old age fund, and ultimately, if they're successful at avoiding home care or nursing home expenses or other financial pitfalls, this money is going to their children and grandchildren. In their mind, this is hopefully mostly inheritance. So the problem that Mary and John have is that their IRA, although they earn the money over their lifetime of working and they set it aside, has always felt like it is 100% owned by them. Many people feel this way. They look at their investment accounts as 100% their retirement fund. The IRS, however, does not feel that way. And this money was put away by John and Mary, and by you if you have a retirement account, with IRS rules. That rule is that they, the IRS, are a part owner of your account. However, how much the IRS owns of your retirement account depends on your planning and your behavior. If you're in the 0 bracket and you pull money out of your IRA, it is possible that you pull money out, expose it to the IRS as possibly taxed, and then the answer is no. You're in a low enough bracket, so even though you took money from your IRA, you do not owe a share to Uncle Sam. The point here is that many people feel their retirement account was the goal line, And that once they hit 62, 65, or whatever their target retirement age was, that was the finish line, and having enough in that retirement account to sustain their life was singularly their goal without considering how much of that the IRS would take in retirement. If that's not all bad enough, the problem often carries into the next generation. If you're 85 at death and your children are in their 60s, they're often in the highest earning years in their lives. Then they should inherit your retirement accounts because of your passing. They're often elevated from the 25% and higher tax brackets up to the highest tax brackets, losing up to 50% or more of your entire life's work in the stroke of one check to the IRS. So you need to do something, but it isn't a bad thing. It's actually pretty easy. It's make a plan. Just like you plan to put the money away, you need to be extremely careful. Very concerned and willing to spend time actually planning the taxation of your retirement dollars until the day you die. It can't be a sedimentary activity or, well, we'll just wait until see what happens attitude. Listen, we want to help you be proactive. Like any great team, there's usually a coach. The coach is hired by the owner of the team, and the coach does the hard work under the supervision of the owner. Consider us your future tax planning coach. You're the owner.